Some work that I've been busy with for, I'd say, the last year or so, and this is joint work with my co-authors, Santosh Anagal and Ben Lockwood, who are both at Wharton, and Tarun Ramadurai, who is at Imperial. So in this question, we've got a very narrow and a very specific question, and we're trying to get at whether or not we can use features of the tax system in South Africa to figure out whether or not firms in South Africa have a preference for paying exactly zero tax. So if we think a bit about corporate income taxes in developing countries, developing economies are going to rely considerably more on corporate income taxes as a source of revenue when compared to their counterparts in developed economies. So if you look at the OECD average, you're seeing that around 9% of tax revenue comes from corporate income taxes in OECD countries. That percentage contribution of corporate income taxes jumps a lot higher in Latin America and Africa, with averages around 15%. The number's quite similar in South Africa as well. Now, despite this feature, Gordon and Lee famously note that overall tax revenue in developing countries is typically much lower, around 2/3 that of developed countries. And a large reason for this discrepancy in tax revenue relates to informality in these economies. So as a result of this, there's an increasing focus on policies that aim to widen the tax base, but specifically you see a large targeting of the informal sector and SMEs, where formalization of these informal businesses is a policy priority. Now, these policies can manifest in various ways, the most common being policies that focus on a simplification of the tax code for small to medium-sized enterprises, policies that aim to lower the cost of compliance, and in some cases, a special tax treatment for SMEs. So with this as a context, we're going to try to say something about whether or not firms potentially display preferences to pay corporate income taxes when given the opportunity to. So what are we going to do in this paper? We're going to study the Small Business Corporation, or SBC for short, tax schedule in South Africa. And what's going to be the important feature about this tax schedule is that there are going to be 3 kinks in marginal tax rate. So we're going to have a progressive tax system where there are going to be 3 points at which the marginal tax rate is changing. Importantly, that contrasts with the standard system for company income taxes in South Africa, which is just a flat tax rate of 28% on all profits. When we have a look at the distribution of corporate tax returns across all 3 of these kinks, we're going to find evidence of pronounced bunching of corporate returns. So by pronounced bunching, I'm referring to a discontinuous spike in the mass of firms reporting values of taxable income that coincidentally correspond to the thresholds in the tax system where the marginal tax rates are changing. We're then going to use this bunching in the data to quantify a key behavioral parameter for tax policy, namely the elasticity of taxable income with respect to the net of tax rate, and we're going to follow the standard methodologies for doing so. When we undertake this exercise to calculate these elasticities, we're going to find that at the upper 2 kink points, or the upper 2 thresholds, that the elasticities we're going to estimate are going to be remarkably consistent. However, when we focus our attention to the lower kink, and the lower kink is a special kink in the sense that the tax rate transitions from a 0% marginal tax rate to a 7% marginal tax rate. I'll explain a bit about that later. We're going to find that the elasticity estimate we measure at that lower kink is going to be 5 times larger than the elasticity estimate we're going to get at the middle and the upper kink in the SBC tax schedule. Now, for the most part, this feature of a much larger elasticity at the lower kink relative to the middle and upper kinks is going to be completely in line with existing research. So Vian Bonzai, who's now at the Reserve Bank, and co-authors, as well as Lediga and co-authors, are going to find a similar feature, namely this greater elasticity at the lower kink. And for the most part, the interpretation of that feature is going to be that small firms are typically more responsive to tax changes. However, if we were to look at the pattern of bunching at the lower kink and contrast this with the visual pattern of bunching at the middle and the upper kink, we're going to see a distinctly different pattern of bunching in the data. And the behavior of firms and the bunching at this lower kink is going to be characterized by substantial bunching of firms right below and on the threshold, and a missing mass of firms above it. And this pattern of bunching is going to be consistent with the theoretical responses we would expect if firms were facing a discrete jump in the tax liability they're facing, so what we call a notch in the tax schedule, and not a change in the marginal tax rate. Right? So we're going to be faced with a bit of a puzzle, namely that the lower kink represents a kink in the traditional sense, but firms are responding to the kink as if it were a notch. And we're really going to devote the rest of this paper to trying to better understand that peculiarity of the behavior of these firms. Now, as I mentioned on the previous slide, the lower kink is quite special, and it's going to be quite special for two particular reasons. The first is that the lower kink involves a transition from a 0% marginal tax rate to a 7% marginal tax rate. Now, importantly, this is a standard kink in the tax schedule, which means that for a income, let's say 75,000 Rand, that corresponds to that threshold, a firm that reports a taxable income below that amount does not pay a marginal tax rate. So it's essentially facing a zero marginal tax rate, so there's no tax liability. But for every Rand of additional income earned beyond that point, the firm pays a 7% marginal tax rate on that additional Rand of income. So this is a standard kink in the tax schedule, but this is also quite an interesting point because it involves a transition from a firm paying zero tax liability to a firm paying a positive but small tax liability. And this is a really nice feature of the tax schedule because typically the point at which firms transition from not paying a tax to paying a tax happens at zero. And zero is a salient income threshold. So income is equal to zero could be, there are a myriad of reasons why income could be zero. What's really nice about the lower kink is that this transition from paying zero tax to paying positive tax occurs at a point at which the firm is already declaring a positive amount of taxable income. And then secondly, to the best of our knowledge, crossing this threshold is going to create little to no additional compliance or filing costs. So firms have to file irrespective of whether or not they're earning an income just below this threshold, let's say 74,000 Rand, or whether or not they're earning an income just above the threshold, say 76,000 Rand. The only thing that's changing at this threshold is the firm either pays a tax or the firm does not pay a tax, but there's no additional compliance or filing costs that the firm faces. So as I mentioned, we have this puzzle that firms are responding to the tax system as if they were facing a notch, when in reality, the tax system implements a kink. So in light of this, we're going to have two questions that we're going to try to answer in this paper. The first is, if we assume that firms were correct in responding to the kink as if it were a notch, how big would this notch or this change in the tax liability need to be in order for us to rationalize the observed behavior of firms? Put differently, if we took the standard theoretical model of bunching at a notch, what would be the value of the change in the tax liability that would rationalize the extent of bunching and the missing mass we see in the data? We calculate that number and we find that number to be quite sizable. So around 11,500 Rand or 16.5% of taxable income for that firm. So the way I want you to think about this amount is that using a standard model of bunching at a notch, for us to be able to rationalize the bunching behavior of SPC firms at the lower kink in the data, a disutility of around 11,500 Rand must exist when firms cross the threshold. So if a firm were to perceive there to be this disutility of 11,500 Rand, that happens whenever they cross the threshold, that is the level of disutility that would be needed for firm behavior to be rational under a traditional model of bunching at a kink. And importantly, just to kind of re-emphasize here, when firms cross that threshold, there are really only two changes happening. There's a change in the marginal tax rate, and firms are going from not paying a tax to paying a tax. But importantly, there's not a change in the average tax rate. There's not a change in the compliance cost. There's not a change in the filing requirement for that firm. The second question here is going to be, okay, if we assume that firms are responding to the kink because they're facing some or other disutility, is there potentially any other explanation that could rationalize the behavior that we're seeing? So essentially what we're going to do is we're going to try to rule out a number of plausible explanations for why firms are responding in the way that they're responding. Most notably, we're going to rule out that firms are doing this because there's confusion about the tax code. So one explanation could be that firms mistakenly think that the change in the marginal tax rate is a change in the average tax rate, but we're going to present some evidence that rules out that as a potential explanation. However, the notch-like bunching we see is suggestive of some type of loss aversion facing the firm. And this is going to be consistent with some recent work by Alex Rees-Jones and Mazar Wassim as well. But what's going to make this particularly interesting is that typically loss aversion is going to scale with the size of the tax or the size of the loss. But in our case, there seems to be a very specific form of loss aversion where firms have a distaste or a dislike for locating on one side of the threshold. And to the best of our knowledge, the only thing that is changing across that threshold is whether or not the firm is actually paying or is required to pay tax or not. So absent any other reasonable explanation for any of these factors that could rationalize the behavior of firms, the observed behavior that firms are displaying would be consistent with the hypothesis that firms have a preference to pay exactly zero tax. If firms had this preference, it would make complete sense that firms would try to avoid crossing this threshold, so that this disutility, this notch value that we're measuring for 11,500 Rand is essentially just a realization of the firm's preference to avoid paying a positive value of tax. All right, so if you believe that this is a plausible explanation, one interpretation of that notch value would be that firms in and around the lower kink have a willingness to pay to avoid paying positive tax of around 11,500 Rand, right? So firms would be willing to essentially pay around 11,500 Rand to avoid paying a tax relative to not paying a tax. Cool. So let's just recap some of the related literature. I'm not going to spend too much time with this, but to kind of start off, bunching has become kind of increasingly prevalent in the tax literature as a way to estimate elasticities. So Henrik Cleven has this really nice survey paper in the Annual Review of Economics. And the main takeaway here for any of you that are unfamiliar with kinks and notches, kinks in a tax system are going to represent changes in marginal tax rates. So if you were to think of the personal income tax schedule in South Africa, at every point that the tax rate changes, those are changes in the marginal tax rates. Whereas a notch is going to represent a change in the average tax rate. There is some literature on corporate income in developing countries. It is quite a small literature at this point, but it is indeed growing. That literature is kind of quick to emphasize features like optimization frictions and informality amongst companies. And then there's also this entire literature devoted to behavioral responses to taxation. That is far too lengthy to summarize here, but two papers I would like to specifically draw your attention to is the first by Alex Rees-Jones in the Review of Economic Studies, where he finds that individuals display loss aversion when they are filing their taxes, and this leads to a greater pursuit of tax reduction activities, right? So there is at least some evidence that loss aversion can explain some of the behavior with respect to tax reduction in the personal income tax code. Then Mazar Wassim has a recent paper in Restat where he finds that taxpayers are much more behaviorally responsive to a marginal tax rate cut to zero than they would be to a similarly sized marginal tax rate change between two positive amounts. So at least in Pakistan, Wassim is able to present some evidence that this zero marginal tax rate may be special for certain reasons, possibly due to salience. So As I mentioned earlier, we're focusing on South Africa in this paper, and we're going to use the universe of individual and firm tax filings in South Africa between 2014 and 2018. We access this data via the UN-UWIDER SA tied collaboration with National Treasury at Treasury's premises in Pretoria. We're going to focus on these small business corporations specifically because they're the subset of companies that have the special tax schedule where we've got 3 kinks. And to just repeat, that is in contrast to the conventional approach, which is a flat tax of 28% on all firm profits that all non-SPC firms are facing. And these SPCs are going to account for roughly 4% of tax revenue, and they're going to account for roughly 1/3 of all firms in the tax system. Now, as I mentioned, these SPCs face a progressive graduated tax schedule that are going to have these 3 kink points. Importantly, there are some eligibility criteria for the SPC program. The criteria is quite lengthy, but I think the kind of 2 most important points to want to highlight here is that a firm would be eligible if their gross revenue is less than 20 million rand in tax year of assessment. And secondly, any shareholders in those firms may not hold shares or hold any other interest in any other company. Right? So there's a much more extensive list of criteria, but for the purposes of this paper, those are probably going to be two of the more important ones. So over here, all I'm doing is I'm showing you what the tax schedule looks like for SPCs in 2018. And what you're going to see is that there are essentially going to be 3 thresholds or 3 kink points in this tax system where there are going to be changes in the marginal tax rate. So for all income below 75,750 Rand, that income is taxed at a 0% marginal tax rate. For all income above 75,750 but below 365,000 Rand, that income attracts a 7% marginal tax rate. That marginal tax rate jumps once you cross that threshold all the way up to 550,000 Rand of taxable income. And thereafter, all additional income above that point gets taxed at the conventional 28% corporate income tax rate. All right, so a firm that qualifies for the SPC program faces essentially a much lower effective tax rate due to the graduated nature of the tax schedule. But importantly, at this lower kink over here, we have a unique scenario here in the tax schedule where a firm earning exactly 75,750 Rand or below pays no tax, and a firm earning 1 Rand above that begins to actually pay tax. But importantly, they're only paying tax on the marginal Rand of additional income, not on the income accrued below 75,750. So as I mentioned, this lower kink transitions from this 0 marginal tax rate to a 7% marginal tax rate. It's a standard kink in the tax schedule, but it's also going to have this transition from no tax liability to a positive tax liability. They're going to be these 2 higher thresholds. And for the most part, all of these thresholds, so when I speak about thresholds, I'm speaking about the level of income, are going to vary across years, for the most part due to CPI adjustments. Now, all firms are going to be required to submit an annual tax return. So whether or not firms are on either side of that lower kink is not going to change whether or not they should be submitting a tax return, even if the firm is making a loss. They're going to be required to submit a return. And for the most part, there's going to be very little hassle factor in paying taxes, right? This could be done with e-filing. This could be done via your bank. This could be done at the SARS branch. And as I mentioned earlier, and just to reemphasize, it doesn't seem that there's any major change in compliance or filing facing firms when they move from below that lower kink to above it. So I'm just going to show you over the next 2 slides some descriptives about SPCs. So in the 2 figures over here, the panel on the left, I'm showing you SPCs as a share of all firms submitting tax returns. And on the right-hand figure, I'm showing you the SPC contribution to total corporate income tax revenue. And what you're going to see is from around 2013, SPCs make up an increasing share of firms. So around 2018, they account for just over 30% of all firms in the tax system. The reason that you are seeing this attendant jump from 2014 increasing throughout is due to the fact that around 2014, there was a change to the SPC eligibility criteria, which saw an increase in the gross revenue threshold from 14 million rand to 20 million rand. So as a result of that increase, firms that were previously ineligible for the SPC program before 2014 that had incomes in the gross revenues in the range of 14 to 20 million suddenly became eligible. And that can partly explain the increasing prominence of SPC since 2014. You're also going to see a similar jump in the SPC contribution to total tax revenue that corresponds to this policy change in 2014 as well. So from 2014 onwards, you're seeing that SPCs are contributing around 4% to total corporate income tax revenue. So for the most part, while SPCs make up a relatively small share of tax revenue, they make up a relatively large share of firms. And then importantly, in 2014, the middle kink is actually introduced in that in the tax schedule. So before 2014, there's actually only this lower and the upper kink. So there's only 2 kink points. In 2014, there's this third point, which corresponds to a marginal tax rate of 21% that was added as well. So for the most part, we're going to be focusing from tax years 2014 onwards. So these policy changes are not really going to affect any of our results. So in the table on the left here, I'm just showing you some descriptive stats for all corporate income tax filings across that period. And for the most part, quite mechanically, SPCs are going to be smaller firms on all dimensions, right? So you're going to see, for example, that on turnover, they're going to be quite small. What I think is also important to highlight here is that the average firm has a negative taxable income. So the average firm is essentially making a loss. But as you can see, the standard deviations there are quite large. So there's a lot of variation. So there are some firms making sizable losses, and there are also some firms declaring sizable amounts of taxable income. You're also going to see that a larger share of SPCs are going to remit payroll taxes. So over here, I'm showing you that 46% of SPCs have corresponding IRP5 filings for their employees, and that contrasts with around 41% of non-SPCs who have corresponding IRP5 filings for their employees. And then finally, something that's going to become important a bit later on is the fact that the use of tax practitioners to assist firms with their tax filings is quite widespread. So for non-SPCs, 72% of these firms are going to actually use a tax practitioner to file the tax return. For SPCs, the number is slightly smaller, but still quite significant at around 65%. So now that we've kind of just set the tone with some descriptive stats, we're going to hop straight into the empirical part of the paper. So as I mentioned at the onset, we're really interested in calculating the elasticity of taxable income with respect to the net of tax rate, which is going to be an important policy parameter. So we're essentially going to follow the now standard bunching methodology of Sayez and Chetty. And for those of you that are unfamiliar with the bunching methodology, the mechanics are quite simple and in some sense quite reminiscent of a regression discontinuity research design. So we're going to specify a counterfactual distribution of firms that would exist if there were no change in the marginal tax rate at a specific threshold. And we're then going to see how this counterfactual distribution compares to the actual observed distribution, which contains the change in the marginal tax rate. And we're going to use the divergence between this counterfactual distribution and the observed empirical distribution to calculate the extent of excess bunching. So how many more firms locate in the region of the threshold at the point at which the marginal tax rate changes in the empirical distribution relative to the assumed counterfactual distribution without a change in the tax rate. And we're going to use this excess bunching in order to calculate an elasticity. So for the most part, there are numerous ways to actually go about implementing this. Our implementation is most closely going to follow that of Mortensen and Whitten's. And for those of you interested in how this differs from Chetty and Sayez, which are maybe a bit more familiar. The Mortensen and Whitten approach is going to be similar to Sayez's approach in that Sayez allows the density function to be discontinuous, whereas Chetty assumes that it's continuous. But an additional benefit of the Mortensen and Whitten approach is that it's going to allow the density to differ in levels and in slopes on either side of the kink point, and that's going to be a particularly desirable feature for us. So to just quickly run through this methodology that hopefully many of you will be quite familiar with, we're essentially going to start off with a regression where our dependent variable is going to be the number of firms locating within bins of taxable income, right? So you can think of N as being the number of firms, and you can think of J as referring to the specific bin of income. We're going to have a constant, and we're then going to include as a covariate the taxable income that corresponds to the midpoint of that income bin. And then we're going to include a series of dummy variables that are going to take a value of 1 if the bin of income in question is a bin that is either the threshold itself or is located within a certain range around that threshold, right? So if the lower kink is at 75,000 Rand, this dummy variable is essentially going to take a 1 for all of the income bins that are around that threshold. And we're going to estimate this model once to the left of the kink, and we're going to do this again to the right of the kink. Then we're going to use the coefficients we estimate from this model to populate a counterfactual distribution of firms. So we're going to use that alpha, we're going to use the beta that we estimate, but importantly, we're not going to include the dummies that correspond to the bunching region. And that's essentially going to allow us to come up with a counterfactual that would exist absent the change in the marginal tax rate, right? So what would the counterfactual distribution of firms look like if there was not a marginal tax rate in the tax schedule? And we're then going to use our dummy variables of year to essentially calculate the number of firms who bunch. And then for the most part, I'm not going to spend too much time on this, but we're essentially going to use all of these parameters in this equation over here, which comes straight out of Mortensen and Whitten. And we're essentially going to observe every parameter in this equation, apart from this variable E over there, which is the elasticity. And we're going to solve this equation for that unique elasticity there. And that's going to be this elasticity of taxable income with respect to the net of tax rate, which is this parameter that we're interested in estimating. So what I'm showing you over here is just in the green dotted line, the observed distribution of firms in bins of income in and around the middle kink that corresponds to 365,000 Rand on the left, and the upper kink that corresponds to 550,000 Rand on the right. In the orange line, I'm showing you the counterfactual that gets generated by our methodology. And essentially at the middle kink, we estimate an elasticity of 0.29. And at the upper kink, we're going to estimate an elasticity of 0.25. So these elasticities are quite similar in magnitude. And if you do have a look at the observed density, as one would expect from the bunching out of kink theory, you're seeing that there's this kind of discontinuous jump in the mass of firms right at the point of the threshold, right? So if you compare this to the counterfactual, there is a much larger number of firms that report a taxable income that corresponds to either exactly the threshold or just to the left or just to the right of that threshold. And the one thing that's quite striking here is that that spike in mass is quite sharp, and it's not really diffuse on either side. So it doesn't seem that there are many optimization frictions facing firms. That response tends to be quite precise. Now, when we look at the behavior in around the lower kink, you're going to see a pattern of firm behavior that looks completely different, right? So you're going to see that there is this large amount of diffuse bunching on the left, right? So it doesn't seem to be quite precise, as was the case at the middle and the upper kink. But you're also going to see that the minute you cross that threshold, the number of firms essentially falls off a cliff. And there seems to be a bit of a hole in the distribution just to the right. So to once again contrast that with the images from the middle and the upper kinks, you're seeing that if you look at kind of the number of firms in either or in the bin either side of these threshold, the numbers are quite similar. There seems to be this symmetric point mass across the threshold, whereas at the lower kink, the mass is very asymmetric, right? So there's a buildup of mass on the left. It essentially then falls off a cliff on the right. And when we apply our elasticity methodology here, we're going to find an elasticity of around 1.38. So a substantially greater elasticity. However, it's quite clear here that the mechanics behind the firm's response is completely different, right? And this is reminiscent of the behavior one would expect if firms were facing a notch in the tax system. So what is likely happening here is that we're using a methodology to measure an elasticity at the kink. We're applying it to a kink in the tax schedule, but where firms seem to be responding as if they were responding to a notch. And that is probably leading to severe misspecification in that model, which probably means that elasticity is substantially overestimated. So just for contrast, what I'm showing you here is the distribution of firms in and around those same thresholds for non-SPCs. So remember, as I mentioned earlier, non-SPCs face a flat tax rate of 28%. So there's really no reason to expect any extent of bunching in and around these thresholds for non-SPCs. So it's definitely not the case that this behavior at the lower kink is driven by some peculiarity about 75,000 Rand, because if that was the case, you'd see it in this figure in the left panel as well. So the bunching behavior seems to be a function of the change in the marginal tax rate and not some other feature. Now, as I mentioned earlier, notches are changes in the average tax rates, and these changes in average tax rates create discrete changes in the tax liability facing a taxpayer when they cross this threshold. In contrast, kinks are going to be changes in the marginal tax rates. And this gives us a puzzle, namely that firms seem to be responding to the lower kink in the SPC schedule as if they were facing a tax notch. So put differently, if I showed you that figure and I didn't tell you that that was a kink, you're most likely to conclude that that is a notch. So based off this puzzle, we're essentially going to have two questions that we're going to try to answer. Firstly, how large would that notch in the tax schedule have to be for us to rationalize the observed behavior of firms? And secondly, what's going to cause the response to a kink that seems far more consistent with responses to a notch? And we're going to answer the first question by essentially estimating the notch value that would rationalize the bunching and the missing mass under a reasonable assumption for what the true elasticity is at the lower kink. And we're going to answer the second question by trying to dig into variation in the notch value with firm characteristics. So the starting point for exploring or quantifying this notch value is the now famous Cleven and Wassim QJE paper that develops a model for estimating the elasticity when firms are facing a tax notch. And essentially, the Cleven and Wassim methodology is able to estimate an elasticity given three parameters: the number of bunching firms, the extent of missing mass, and the value of the notch. So we're going to use that framework of Cleven and Wassim as a starting point, and we're essentially going to invert it. In that, we're going to try to estimate the notch value given bunching firms missing mass, but taking the elasticity as given. Right? So with Cleven and Wassim, the elasticity is the unknown, the notch value is given. We're going to invert that and assume that the elasticity is known and use that to then estimate the notch value, which in our case is the unknown. And we're essentially going to use the elasticity estimate we get from the middle kink as an estimate for what we hope is the true elasticity at the lower kink. but I'll also show you that our results do go through for different assumptions of what the true elasticity at the lower kink is. And essentially using the number of bunching firms, which you observe from the data, the missing mass, which you observe from the data, and our assumption about the elasticity, we're going to search for the value of a notch, for the unique value of a notch that would rationalize the bunching, the missing mass, and the elasticity that we see in the data. So we're essentially going to undertake this procedure, and we're going to find that the value of that notch, so the notch that rationalizes the behavior, is around 11,500 Rand, or 16% of the taxable income at the lower kink. So how should you be thinking about this notch value? Well, if you assumed the standard model of bunching at a notch, so this is the Clevin and Wasim model, and you apply that bunching at the notch model to this figure on the left over here, the only way for that model to rationalize the extent of bunching on the left of this threshold and the missing mass on the right of this threshold is if there were to be a discrete jump or increase in the tax liability of firms of around 11,000 Rand when they cross this threshold, right? So when they move from left to right. Now, this need not be an increase in the perceived tax liability. It could also just be an increase in the perceived disutility, right? So firms could essentially perceive there to be some or other disutility that exists when they cross this threshold, and that the money metric value of that disutility is around 11,500 Rand, which is quite sizable, right? So around 16.5 or 16% of taxable income. So that is the amount of the notch that would rationalize the bunching, the elasticity, and the missing mass under the standard model of bunching at a notch. Now, one point here could obviously be that, you know, the assumption for using the middle kink elasticity as a proxy for the true elasticity at the lower kink may be incorrect. So what I'm showing you here is a figure where I've got the notch value estimate on the y-axis and different assumptions for the elasticity at the lower kink on the x-axis. The dotted line is showing you the value of the middle kink elasticity, which is the one that we use in the paper. And what you can see here is that if you assume that the elasticity was actually smaller at the lower kink, the notch value increases. And even, for example, if the value of the elasticity were to be twice as high as what we're assuming it to be, so around 0.5, the notch value is still around 6,000 Rand. Right? So it's still a sizable amount, considering that the taxable income of these firms is around 75,000 Rand. Now, what are some alternative explanations that could explain what's happening here? So firstly, you may wonder if firms or the taxpayers at the lower threshold mistakenly believe that the kink is a notch. So what could be happening is that firms locating on the left of this threshold mistakenly think that when they cross to the right of this threshold, there's going to be a change in their average tax rate and not a change in their marginal tax rate. Now, if they believe this to be the case, there would be a perceived increase in the tax liability from 0 Rand to 5,000 Rand. And even if that were the case, it's still substantially lower than our estimate of the notch value of around 11,500. However, some more evidence against this hypothesis are these two figures I'm presenting below. So on the left, I'm showing you the behavior of firms in and around the lower threshold that do not use a tax practitioner. And on the right, I'm showing you the bunching behavior of firms that do use a tax practitioner. And if you assume that the use of a tax practitioner corresponds in some or other way to knowledge about the tax system, you would expect to not see this behavior amongst firms who are using tax practitioners. And what you're seeing on the figure on the right here is that that same pattern we see in the aggregate data appears even for the subset of firms who are using tax practitioners. And once again, if you're assuming that tax practitioners do not misunderstand the tax code, then misunderstanding or confusion about the tax code cannot explain the behavior that we're seeing in the data. Another explanation could be something to do with tax morale, right? So there's this entire literature on tax morale And there is at least some evidence that, when local ruling parties differ from national government, there could be some differences with respect to tax morale and willingness to want to pay tax. So what I'm showing you over here is the same figure for firms located in KwaZulu-Natal on the left, in the middle firms located in the Western Cape, and on the right firms located in Gauteng. And for the most part, while the notch values do differ across these three subsets, it's around 19,500 in the Western Cape, 15,000 in Gauteng, and around 9,000 in KwaZulu-Natal. This asymmetric pattern is consistent across firms in different regions of the country. So if there is some explanation about tax morale, it can maybe help us to explain differences in the notch value across these different provinces, but the asymmetric pattern still exists in the bunching behavior of firms in different parts of the country. Now, another class of explanation is potentially that there's some other hassle factor, right? That there is just such a large compliance cost that comes with paying taxes, and that firms are going to try their best to avoid paying a tax because of this mammoth compliance cost facing them. But for the most part, taxes can be paid fairly easily: online banking, at a SARS branch, the e-filing, desktop, mobile app. And importantly, crossing the first threshold doesn't change the filing cost, right? So firms are filing irrespective. And it seems a bit implausible that the compliance cost of paying a tax is so substantial that it generates the patterns that we're seeing in the data. The second class of explanations could be that there are maybe some optimization frictions, right? So firms would ideally like to perfectly target their taxable income to the exact value of the threshold, but for some other reason, they can't do that. And because they can't do that, they may underestimate or they kind of may over adjust their expenses, and that could create this asymmetry on the left. And that would surely be an explanation for the asymmetry on the right. But an optimization doesn't explain why you're not seeing diffuse bunching on the right-hand side of these figures, right? So optimization frictions would predict a diffuse bunching, but it would not predict diffuse one-sided bunching. So the final piece of evidence I just want to present to you is a result from a regression that we undertake, where we essentially take a dummy variable that takes a 1 if the firm bunches at the lower kink, and it takes a 0 if the firm does not bunch at the lower kink. And we're essentially going to regress that variable on a wide range of firm characteristics to see what or if any observable characteristics of firms can help explain the behavior of these firms who appear to be notching at a kink. So what I'm showing you just here is the coefficients with their values on the y-axis, and I'm including their significance in the standard way on top of the columns. So the first thing I'd like to show you is in this kind of green over here. So these are quartiles of gross income. So what you're seeing here is as we move from quartile 2 to quartile 3 to quartile 4, the likelihood that a firm bunches at the lower kink is an increasing function of their gross income. In the same way, the likelihood that a firm bunches at the lower kink is an increasing function of the profit margin. So the greater the firm's profit margin, the more likely that firm is to be one of the firms that bunches at the lower kink. Interestingly, however, when we look at the purple bars over here, which are expenses, the larger the firm's expenses tend to be, the lower the probability that the firm actually bunches, right? So if there is some evasion happening here, it seems to largely be coming through the reporting of income and not necessarily through the reporting of expenses. What you're also seeing here is that new firms, so firms entering the tax system for the first time, are more likely to bunch. And specifically over here, firms that use a tax practitioner are more likely to bunch. And if a firm bunched in the previous year, they're actually more likely to bunch in the following year as well. So in this figure here, I'm showing you the same set of results, but in this regression, we're simply including a firm fixed effect. right? And the biggest change from this figure is that in the previous scenario, without the firm fixed effect, bunching in the previous year resulted in a greater probability of bunching the following year. However, what we're seeing now is that coefficient becomes negative, large and significant, which indicates really that this repeat bunching tends to be a firm specific effect. So there seem to be some firms that just persistently bunch and others who do not. And if you were to control for this tendency, there is at least some reversion in the tendency to bunch. But once again, bunching probability increases with income and increases with profit margin. So if we assume that optimization frictions, hassle factors, confusion about the tax code, tax morale, that none of these factors can explain the behavior, one explanation that would be consistent with the observed behavior is if firms had a preference to avoid paying exactly, or if firms had a preference to avoid paying a positive tax. Put differently, if firms had a preference to pay exactly zero tax. And our empirical setup kind of really leads to this insight, because crossing the lower kink involves going from paying no tax to paying a tax. And if we can rule out any of these additional factors, it becomes a bit difficult to think of any other explanation that would cause this kind of one-sided diffuse bunching. And as I mentioned earlier, Wasim at least finds some evidence in Pakistan that taxpayers are more responsive to a marginal tax rate cut to zero than a similarly sized marginal tax rate change between positive amounts. So it at least seems that when tax rates are cut to zero, that this produces a far greater response amongst taxpayers than if there were a tax rate cut to a positive number. So if you accept that what we're seeing in the data is this preference to pay exactly zero tax, then our interpretation of this notch value would be that firms' willingness to pay to avoid paying positive taxes is around 11,500 Rand, which is quite substantial, which also suggests that, unsurprisingly, firms do not like paying taxes. And it's not a story of firms do not like paying a lot of taxes. So it's not an intensive margin story. It's really this extensive margin story, that firms perceive there to be a sizable disutility when they pay a tax relative to when they do not pay a tax. So just to recap, in this paper, we're estimating the elasticity of taxable income for SPCs in South Africa, and we're going to find broadly similar results to existing studies. However, on the way to doing this, we discover this quirk in the data where firms at the lower kink display a distinctly different pattern of bunching, where it appears that firms are responding to the lower kink as if they were facing a notch. So given this observation, we try to explain this behavior through a range of plausible explanations, and we rule out common explanations such as confusion about the tax code. And given the fact that we rule these explanations out, one interpretation, which is our preferred interpretation, but may be one of many interpretations, is that the evidence presented would be consistent with the fact that firms do indeed have a strong preference to avoid paying a positive amount of corporate income tax. Thank you very much. So yeah, Anurivia, if there are